Markets are sending a confusing signal. Gold and silver are climbing higher, while Bitcoin quietly slips lower. This divergence raises an important question about where capital is moving next. For years, Bitcoin was called digital gold. But today, traditional safe havens are outperforming, forcing investors to rethink what truly protects wealth during uncertain economic conditions. This shift is not random. It reflects deeper changes in global liquidity, interest rate expectations, and growing fear that economic stability may be weaker than official headlines suggest. Gold prices push toward new highs as institutional buyers increase exposure. Central banks continue accumulating metal, quietly signaling distrust toward paper currencies and expanding sovereign debt. Silver follows closely behind, driven not only by safe haven demand, but also by rising industrial consumption tied to energy transition and advanced manufacturing technologies. Meanwhile, Bitcoin struggles to maintain momentum. After explosive rallies, volatility returns, reminding investors that crypto still behaves like a high-risk asset during tightening financial conditions. Rising real yields place pressure on speculative assets. When money becomes expensive, investors prioritize capital preservation over aggressive growth and leveraged exposure. This environment favors assets with long histories of trust. Gold and silver have survived wars, currency collapses, and policy mistakes for thousands of years. Bitcoin, by contrast, has only existed through an era of ultra-loose monetary policy. Its true stress test begins when liquidity tightens and risk tolerance disappears. The recent pullback suggests that investors are no longer treating Bitcoin as a hedge, but as a speculative technology asset vulnerable to macroeconomic shocks. At the same time, gold ETF inflows accelerate. Large funds quietly add exposure, avoiding headlines while positioning for prolonged uncertainty and potential currency debasement. Silver's thinner market amplifies price movements. Even modest institutional demand can trigger sharp rallies, catching retail investors off guard. This divergence exposes a crucial truth. Not all alternative assets behave the same when fear replaces greed in global financial markets. Smart money watches correlations closely. When Bitcoin decouples negatively from gold, it often signals a shift toward defensive positioning across portfolios. Retail traders often notice price moves last. Institutions move quietly, weeks or months before headlines explain what already happened. The question is not whether Bitcoin will survive. The question is whether it belongs in the same category as gold during periods of financial stress. History suggests that during uncertainty, tangible assets outperform narratives. Investors seek what cannot be diluted, frozen, or printed into existence. Gold and silver do not promise innovation. They promise stability. In times of fear, that promise becomes extremely valuable. Bitcoin's long-term story remains powerful, but short-term cycles expose its dependence on liquidity, speculation, and risk appetite. This rally in precious metals may be signaling something deeper, a warning that the global financial system is entering another fragile phase. Interest rates sit at the center of this divergence. As yields remain elevated, capital naturally flows away from speculative assets toward instruments offering stability and inflation protection. Higher rates increase opportunity costs. Investors holding Bitcoin earn nothing, while bonds, cash equivalents, and precious metals regain relative attractiveness. Real yields matter more than nominal numbers. When inflation-adjusted returns rise, risk assets face pressure as leverage unwinds across financial markets. Gold historically performs best when confidence in monetary policy weakens. Rising debt and persistent deficits raise doubts about long-term currency stability. Central banks respond by diversifying reserves. Record levels of gold purchases signal preparation for a world less dependent on a single dominant currency. Silver benefits indirectly from this trend. As gold prices rise, silver often plays catch-up, driven by its hybrid role as both monetary and industrial metal. Meanwhile, Bitcoin faces a different challenge. Regulatory uncertainty and tightening financial conditions reduce institutional risk appetite. When liquidity contracts, correlations rise. Bitcoin begins trading more like equities than an independent store of value. The US dollar plays a crucial role. A stronger dollar typically pressures Bitcoin, while gold can sometimes resist through safe haven demand. Currency strength reflects global stress. When investors rush into dollars, it signals fear rather than confidence in economic growth. Gold thrives in this paradox. It benefits from fear-driven demand even when the dollar strengthens, highlighting its unique role in financial markets. Silver's volatility increases during these transitions. Small shifts in demand create exaggerated price responses, rewarding patience and punishing weak conviction. Bitcoin investors face emotional stress. Sharp drawdowns test belief in long-term narratives as short-term price action dominates attention. Institutional portfolios rebalance methodically. Exposure shifts toward assets historically resilient during tightening cycles and macro uncertainty. Liquidity cycles repeat throughout history. Assets rise when money is easy and fall when conditions tighten. Gold and silver often move first. Bitcoin's correlation with liquidity is undeniable. Its strongest rallies align with expansionary policy and aggressive stimulus. Without fresh liquidity, speculative enthusiasm fades. Prices drift lower, even when long-term conviction remains intact. Gold, however, thrives on distrust. Each policy misstep reinforces its appeal as insurance against financial system instability. Silver amplifies that message. Its industrial demand ties economic slowdown fears directly into its pricing dynamics. This macro backdrop explains today's divergence. It is not about technology versus tradition, but about risk, trust, and survival. Smart money rarely chases headlines. It positions early, quietly reallocating capital long before price movements capture public attention. Gold ETF inflows reveal this behavior clearly. Institutions accumulate during consolidation phases, not after explosive rallies dominate financial news cycles. These flows signal defensive positioning. Large funds reduce volatility exposure while maintaining liquidity and long-term purchasing power protection. Silver ETFs, though smaller, experience amplified effects. Limited supply means even modest allocations can drive disproportionate price appreciation. Meanwhile, Bitcoin ETF flows slow or reverse. Short-term traders exit positions, responding quickly to macro pressure and declining momentum. This does not imply rejection of crypto. It reflects timing. Institutions adjust exposure based on cycles, not ideology or online narratives. Retail investors often react emotionally. They buy after confirmation and sell after losses, reinforcing volatility rather than capturing opportunity. Smart money exploits this behavior. It accumulates when sentiment is uncertain and distributes when optimism peaks. Gold sentiment rarely becomes euphoric. That restraint allows sustained trends to develop without speculative excess. Silver, however, is emotional. Its history includes explosive rallies followed by brutal corrections, rewarding discipline and patience. Bitcoin's narrative-driven cycles amplify extremes. Fear and greed dominate shorter timeframes, overwhelming fundamental adoption metrics. Institutional traders watch volatility closely. Rising instability prompts reduction in exposure to assets lacking defensive characteristics. Gold's low counterparty risk becomes critical. It requires no issuer, no network uptime, and no regulatory approval to retain value. Silver shares this advantage while adding industrial relevance. Its demand base expands beyond investors into technology and energy infrastructure. Bitcoin remains powerful but conditional. Its performance depends on sentiment, regulation, and access to cheap liquidity. This reality reshapes portfolio construction. Defensive assets rise in importance as uncertainty dominates global economic outlooks. Gold and silver act as insurance, not speculation. They rarely excite social media, but they preserve wealth when confidence erodes. Bitcoin's decline does not erase its future. It highlights its cyclical nature and sensitivity to macroeconomic conditions. Smart money understands timing. It steps aside when conditions deteriorate, ready to return when liquidity improves. The divergence continues to widen, offering clues for investors willing to look beyond headlines and price alone. Every major financial cycle eventually confronts fear. When optimism fades, investors reassess risk and return to assets that have historically preserved value. Gold has played this role repeatedly. During crises, it becomes a psychological anchor, offering stability when confidence in institutions weakens. Silver mirrors this behavior but with greater volatility. Its smaller market magnifies emotional responses during periods of stress. Bitcoin has yet to experience multiple prolonged tightening cycles. Each downturn provides new information about how it behaves under pressure. In recent episodes of uncertainty, Bitcoin trades like a risk asset. Capital exits quickly as investors seek liquidity and safety. Gold's strength during fear is not accidental. It is embedded in collective memory as a store of value beyond political or technological systems. Silver's history is equally deep. It has functioned as money, trade settlement, and industrial input across centuries of economic evolution. During market stress, narratives lose power. Investors abandon future promises and prioritize assets that already embody trust. Bitcoin's narrative remains compelling, but fear compresses time horizons. Long-term visions struggle when short-term survival dominates decision-making. This psychological shift drives divergence. Metals benefit from instinctive behavior, while speculative assets suffer from reduced patience. Historical data supports this pattern. During tightening cycles, gold often stabilizes portfolios as equities and crypto decline together. Silver adds leverage to this trend. Its dual demand links fear-driven investment and long-term industrial growth expectations. Bitcoin's volatility tests conviction. Drawdowns expose investors unprepared for multi-year consolidation phases. Market psychology repeats. Fear creates opportunity for those able to detach emotionally and act rationally. Gold and silver reward patience. Their movements are slower, but their reliability compounds over extended periods of uncertainty. Bitcoin rewards timing. Entering during liquidity expansion matters more than conviction during contraction phases. Understanding fear cycles allows investors to rotate assets strategically rather than react emotionally to price swings. Ignoring fear does not eliminate it. Markets eventually force recognition through volatility and capital losses. Gold and silver's rally may represent early acknowledgement of systemic risk returning to global markets. The question becomes preparation. Investors must decide whether to follow emotion or follow evidence as conditions evolve. Every market divergence forces a decision. Investors must choose between chasing momentum or aligning with forces shaping the next economic cycle. Portfolio construction is no longer optional. Concentrated exposure to risk assets leaves investors vulnerable when liquidity conditions tighten unexpectedly. Gold restores balance. It does not generate income, but it protects purchasing power when monetary credibility weakens. Silver enhances diversification. Its industrial relevance positions it for both defensive phases and long-term technological expansion. Bitcoin occupies a different role. It represents asymmetric opportunity rather than immediate protection during macroeconomic stress. Treating Bitcoin as digital gold may oversimplify reality. Its volatility suggests it behaves closer to emerging technology than monetary insurance. This distinction matters. Investors expecting stability from Bitcoin during downturns risk disappointment when liquidity disappears. However, dismissing Bitcoin entirely ignores its future potential. Innovation often thrives after prolonged consolidation and skepticism. Timing remains critical. Bitcoin historically performs best after monetary easing begins, not during tightening phases. Gold often moves first. Its rallies frequently precede broader recognition of economic stress and policy response. Silver tends to lag initially, then accelerate sharply. This delayed reaction creates explosive upside during late-cycle transitions. Understanding sequencing improves decision-making. Different assets lead and follow depending on where markets sit within the cycle. Ignoring cycles invites frustration. Markets rarely reward impatience, especially during periods of tightening and uncertainty. Gold and silver reward discipline. Their role is preservation first, appreciation second. Bitcoin rewards conviction paired with timing. Holding through drawdowns requires psychological resilience and realistic expectations. The current divergence reflects caution, not collapse. Capital is repositioning, not disappearing. Gold and silver attract defensive flows, while Bitcoin waits for confirmation that liquidity conditions are improving. When policy shifts arrive, correlations may change again. Bitcoin could regain strength rapidly under supportive conditions. Until then, metals dominate the safety narrative. Their rally reflects preparation rather than speculation. Markets reward awareness. Understanding why assets diverge matters more than predicting short-term price movements. Fear cycles will pass, they always do. What matters is how portfolios are structured when they arrive. Gold and silver offer resilience. Bitcoin offers optionality. Together, they represent different responses to uncertainty. The mistake is expecting one asset to perform every role. Markets punish oversimplification. Diversification is not about maximizing returns. It is about surviving volatility long enough to benefit from opportunity. As gold and silver rise while Bitcoin declines, markets communicate a message worth listening to carefully. That message is caution. Liquidity is scarce. Risk must be priced appropriately. Ignoring this signal does not eliminate risk. It merely delays recognition. Gold and silver respond first because they always have. Bitcoin will respond later when conditions allow. Understanding timing separates investors from speculators. One survives cycles, the other chases them. This divergence is not a verdict. It is a chapter in an ongoing financial story still unfolding. The next phase will reward preparation, patience, and respect for macroeconomic forces. Those watching only prices may miss the lesson. Those watching behavior gain insight. Gold and silver signal defense. Bitcoin signals opportunity waiting for the right moment. Markets move in cycles, not straight lines. Understanding this prevents emotional decisions. The divergence today becomes clarity tomorrow. Patience turns confusion into strategy. Gold, silver, and Bitcoin each play a role. Knowing when each matters is the real advantage. Markets do not reward certainty. They reward adaptability. As conditions evolve, capital will move again. The cycle never stops. Those prepared will recognize the shift early. Others will react after the opportunity passes. Gold and silver rise. Bitcoin pauses, the market speaks. The question is who is listening.